Welcome back to World Crisis Radio. Now, changing gears, it is important that Obama himself was confronted by Stephanopoulos on ABC Evening News last night, I believe, about the birth certificate question, which he tried to finesse, but in a real campaign environment, that's going to get to be harder and harder to do. But now, we're going to be devoting the rest of the some of the rest of the broadcast to the world economic situation. Now, we've been looking forward to hearing from Dan Abramson down in Austin, Texas, about the current situation with derivatives, the potential of a Wall Street sales tax. That's the issue that hovers over this entire idiotic budget debate, is the refusal of the two parties to talk about the Wall Street sales tax. So since they won't, we will. Let's hear more about the tremendous opportunities from the Wall Street sales tax from Dan Abramson. Welcome, Dan. Take it away.
Hey, I appreciate it, Webster. I'll get right into it, and thank you for the opportunity. What's interesting with the derivatives tax, or the Wall Street sales tax, as we call it, is it's an idea whose time has come, and we're starting to see that. This budget debate and the austerity psychosis that has gripped Obama, that has gripped the Republican Party, and threatens to undo the New Deal, to strip away Social Security and Medicare and Medicaid and food stamps and the social safety net of this country, and basically turn us into a third world banana republic ripe for looting. The derivatives tax is our weapon against this. Now, it is coming out in the budget debate this week. What we saw was the Progressive Caucus, which is about 50 members of the House, all Democrats, came out with their people's budget, as they called it. Now, they actually had a securities transfer tax in that budget, but it is pathetic and it's weak. It is 1/100th of 1% of every transaction, and they're only hoping to generate $40 to $60 billion a year. I appreciate that they've included it. It's utterly unacceptable, and it shows that they lack the vision to see how powerful this is as a tool for generating revenue. Again, as I've mentioned previously on your show, you are talking at a minimum $3.7 quadrillion traded in derivatives every year, and that's just what can be monitored. It's probably bigger than that. The kind of tax we're talking about is 1% of every transaction. We need to generate real revenue here to rebuild this country with a new Works Progress administration, to actually put people back to work, to modernize this economy. This Progressive House caucus was talking 1/100th of 1%. This is even weaker than the Peter DeFazio and Marcy Kaptur proposal of 2009 that hoped to do 1/4 of 1%.
Dan, can I just ask you, what would they tax? Would they tax derivatives or just stocks and bonds, or what?
They would tax some options, and they would tax some swaps. What was so disappointing about the report, Webster, is they really lack specificity as to whether they were going to go after the OTC stuff. And as you know, that's where the money's at. You know, when you're talking about the big money in derivatives, there's the $700 trillion or so that the papers will talk about, and then there's all the stuff that's off the books. And if you're not talking about regulating and taxing that, you've basically given up 7/8 of the whole market. So it really lacks specificity in both of the reports, and I think that's why they're only saying it's going to generate $50 billion, because they're not going to attack every part of the derivatives market, and certainly not the hedge fund market either. The other thing I want to mention before I go into the high-frequency trading, because I know we're limited on time, the derivatives tax is being hijacked right now, and what we're seeing is economists like Jeffrey Sachs, the CFR darling, the IMF darling, and the Gates Foundation, always involved in nefarious activities, are now pushing for a derivatives tax, as are leaders at the G20. We just saw a few days ago a world economists are recommending to G20 ministers to accept the Robin Hood tax. Now, what they're saying is, let's have a global speculation tax of 0.5 of 1%, but what we're going to do is use it to fund the UN and this Malthusian climate change takeover. So they want to fund the IMF and the UN and climate change through a derivatives tax. I think it's important to reiterate over and over again, this is not my position, Webster. I don't think at all this is your position.
No.
What we're talking
No
about,
way.
this is a derivatives tax to rebuild the United States. This money is not for globalist bankers. It is not for IMF hyenas. It is not for the vampires that are sucking this planet dry. This is a derivatives tax to tax speculators so we can put money into the productive economy. There is a big difference. The idea is being hijacked, it is being co-opted, and it's time to take it back. One more thing I'll mention on this people's budget, it lacked a coherent plan on a WPA-like approach. They proposed $1.7 trillion in building over the next decade. That is entirely too weak. We need $1.7 trillion right now, and we could generate at least $5 trillion if we split it 50-50 with the states with this derivatives tax we're talking about. What they've done is they've merged the derivatives tax into 50 other bullet points, and they don't see the power of it. Now, if I can move on, I want to talk about high-frequency trading. It very much links into the kind of speculation we're talking about. Webster, you had amazing research on the flash crash of April 6th, where you saw stocks lost 99% of their value within a matter of minutes. And for the first time, this exposed something that I've been researching for years, which is this high-frequency trading phenomenon. A lot of people think that when there are stock market trades, you still have what are called specialists, the guys you've seen in the movies with blue coats who stand on the floor and make the trades. That is part of yesteryear. That no longer exists. Up to 70% of the trades that are being made on the New York Stock Exchange, NASDAQ, and other exchanges now are done electronically, but it goes bigger than that. They're done by algorithmic computers. These are systems set up by PhDs, by computer scientists who have set up basically third-party markets called alternative trading systems or dark pools of liquidity, where there is no transparency, there are no posted quotes, none of the information is actually let out to the public. So when you see trillions of dollars in hedge funds moving through, for example, Citadel is one of the biggest players, and of course, who's the biggest player? Goldman Sachs. Goldman Sachs owns one of these high-frequency trading outfits, and they also own an electronic exchange. They are making up to $100 million a day, and the New York Times has done actually quite decent coverage of this, talking about how Goldman Sachs has made money every single day of the year. They are raking in at least $100 million a day for 35 days straight, they talk about. They did not have a losing day. Now, how do they do it? The Times says, quote, they can spot trends before other investors can blink, changing orders and strategies within milliseconds. So what they're able to do is they send out snipping orders to see where the price is, where the limit order is. When a typical investor buys a stock for, say, $25 a share, he'll put in a limit order and say, don't buy it below $29.50, but don't buy it above $29.52, okay? What they'll do is they'll sniff out that information, buy the stock in front of that investor, and then sell it to him at a penny more. And they do this over and over and over and over again. This is illegal. This is criminal. This is what you would call insider trading. If you were traditionally to do this, you would be put in prison. Instead, what they're using this for is to prop up their insolvent zombie banks that are losing money in the derivatives black hole of all the debt they invested in from real estate and other consumer debt, other commercial real estate. So what we need to do is start taxing and regulating this high-frequency trading, and the SEC is woefully unprepared right now. We need to capture this revenue and rebuild the United States. As part of the derivatives tax, we need to talk about taxing high-frequency trading.
Okay, Dan. Come back next week for another installment. We'll be back in a minute
Webster,
on World Crisis Radio.